Hello, I'm Udayan Mukherjee, and today we're going to talk about the importance of the balance sheet in determining whether you're going into a good stock or a bad stock. Everybody looks at the profits of a company, but that comes in the income statement. And we've spoken earlier about the P multiple. All of it is linked with the sales and profits of the company. However, the balance sheet tells you a different story. It tells you structurally whether a company is strong or weak. It does not give you a snapshot of what the previous year was like or the coming year is going to be like. It's almost like a building block of a company rather than a one-year snapshot of a company. And it often tells you a lot of very interesting things which can be warning signals for investors about whether they should not be getting into a stock, or it could be a very big attraction for getting into a company. The most important part of the balance sheet is to look at the debt of a company. How much debt does a company have relative to its equity? The first question you should say is, what is the market capitalization of the company? Say the market cap of a company is 200 crores. And then you look into the balance sheet and you see there is a 600 crores debt sitting there. And then you say 200 crores is the market value of the company, but 3 times of that is the debt sitting on the books. That makes the company a little vulnerable, because where will the servicing of this debt come from? So the debt equity ratio, which is pretty much the debt divided by the equity capital of the company, is the debt equity ratio. It's a very, very important ratio for most investors to monitor, because the higher the debt equity ratio, the more leverage the company is, the more loans the company has taken, which have to be paid back from profits accrued. And if the number is greater than 2, debt equity greater than 2, you slowly start to wonder whether you're beginning to get into a risky company. So the higher the debt to equity or the debt to market cap, the more vulnerable or the more risky is the company. But it's not as simple as that, because it depends on the sector that you're operating in. Let's take a sector like information technology. Information technology is a sector which generates a large number of cash profits every year. And it does not need huge number of assets. Sure, they need offices, but they don't need plant and machinery and thousands of crores of investments to manufacture anything. It's a services industry. They just need to put people in their cubicles who work on computers and they churn out the profits. Therefore, by definition, IT is a sector where the debt levels are low. And therefore, if you see a low debt equity ratio for an IT company, it's nothing to get excited about, or to say I must buy this company because the low debt equity ratio is there, because almost every company in the sector has a low debt equity ratio. However, the opposite is true of companies with large asset bases, typically manufacturing companies like metals, steel companies, aluminum companies. Now, where does the money to build all these huge aluminum plants and steel plants come from? Part of it may come from equity, but a large part of it also comes from debt. So, by definition, these sectors will have much higher debt equity ratios than IT companies. So you need to keep that in mind, and not to dismiss a company simply because it has a high debt equity ratio. It is normal for many metal companies to have debt equity ratios of 1.5 to 1 or 2 is to 1 or even 2.5 is to 1. So there you start looking at the industry average and you start to compare it with other companies. But thumb rule, any company with debt equity ratio of more than 3 is beginning to skate into dangerous ground. And then you need to do a lot of further analysis. What kind of further analysis? You then start looking deeper down into the balance sheet and examining a ratio called the interest coverage ratio. Now, what is the interest coverage ratio? It is simply telling you whether the profits of a company are enough to pay the interest expenses to service the debt that it has taken in any particular year. So we take the cash profits. We take something called EBIT, earnings before interest and taxes. We take that as a thumb rule or a proxy for the cash profits of a company. And you divide that by the interest expenses. So let's say a company has debt of 200 crores sitting on their books. On 200 crores, it pays interest expenses of 20 crores a year. It may be a bit more or less. So where will the servicing of this 20 crores of interest payment every year come from? It has to come from profits, so it has to come from the EBIT. Now let's say the EBIT of the company in that particular year, or the earnings before interest and taxes, is 40 crores. Now 40 crores divided by 20 crores, which is your interest expense, is basically your interest coverage ratio. So 40 EBIT divided by your interest expenses in a particular year, interest burden, is the ICR, or the interest coverage ratio. It only tells you that your profits can pay 2 times the interest expenses in the year. So in a particular year, if your interest outgo is 20 crores, your profits are enough to cover 2 times that. And that is the area where it begins to become comfortable. The more the better for the interest coverage ratio. For a company, if the interest coverage ratio is say 4, then it is making profits enough to pay the interest expense 4 times. So they are in a very, very comfortable liquidity position. Now think of a company, the opposite, which is where the interest coverage ratio is 0.75, which means that for the 20 crores of interest that they have to pay, they're only making 15 crores of profit. 15 by 20 is 0.75. So they are not able to cover their interest expenses from the EBIT or the earnings of the particular year, and that puts it in a very, very dangerous situation. In fact, it raises the risk of the company actually defaulting on interest payments and therefore even going bankrupt. So keep a thumb rule in mind when looking at a balance sheet. An interest coverage ratio of more than 2 or 3 is comfortable, below 1 is dangerous, and the lower you go into the decimals, the more shaky ground the company is in. Which brings us to the next ratio, which is not related to the debt as much as whether the company is using its assets profitably. It's called the asset turnover ratio. So the balance sheet will easily tell you what are the total assets of a company. Total assets and total liabilities are a foundation of any kind of balance sheet information. So you take the annual sales of a company, very simple, from the income statement, and you divide it by the total assets of a company, and that gives you the asset turnover ratio. Now, what is a high asset turnover ratio? Where the sales number is high and the assets are okay, and therefore the higher the sales, the higher the asset turnover ratio. The high asset turnover ratio tells you that a company is using its assets very productively and converting those assets successfully into sales. It is monetizing its assets successfully. So the higher the asset turnover ratio, the better the company. What does the low asset turnover ratio tell you? It tells you that the company has over the years amassed a lot of assets, but they're not able to use those assets to convert it into actual revenues, which is what the purpose of creating assets is in the first place. So basically, a company is sitting on unproductive assets, and that makes it not such a great company to invest in. So whenever you see a low asset turnover ratio on the balance sheet, you start to begin to get worried. Now, connected to this business of what kind of profitability a company has, you have ratios like the return on equity and return on net worth. Often, these ratios are made for you in the balance sheet. You just can see, or you can divide the returns by the equity base or the net worth of the company and arrive at these numbers. But usually they are very easily available, return on equity and return on net worth. Now, a discussion on a high ROE or high RONW can get complicated. So I'm going to simply tell you to look out for the kind of numbers that you should be expecting. For a good company, in most cases, look out for a return on equity or return on net worth of around 16-17% or higher. The moment you start crossing that ROE, RONW of more than 16-17%, basically it's telling you that the profits generated by the company are way in excess of the cost of capital of the company, which is where you start making the money. Companies borrow or they raise capital in a certain form, and they have to have profits which are greater than the cost of capital. And whenever that happens, they're basically making excess cash flows. So 16 to 17% is where it starts looking good. And if you see a company over the last 4 or 5 years demonstrating a track record of more than 20% consistently ROE or RONW, then you are onto a good thing. Then you say, I want to be a company like this. Then you look at other things like the PE multiple, etc., to see whether it's too expensive or not. But a company which consistently delivers or is showing you more than 20% ROE or RONW on the balance sheet is most likely to be a wealth creator for you. So keep that in mind. Hope these are some things which are useful for you from the balance sheet. There can be lots more, but I gave you some glimpses today of the key things to watch out for, which might determine whether you're getting into a good stock or there are some red flags out there which you should be very careful about.
If you like the video, do like, comment, share and subscribe.